saying thank you for finding time to attend this webinar. I appreciate it's a very busy time for you all, and the webinar was advertised on such a short notice, so I appreciate your joining. I'm going to introduce myself for those who don't know me. I am Dinara. I'm Audit Methodology Director in Nexia Global Office. I'm responsible for driving our initiatives to develop audit methodology, develop audit tools, develop templates to make audits, to make just our life easier, to help us with delivering audits with efficiency and high quality. I'm especially passionate about data analytics because I believe it will help us to focus on bits of audits that are really truly interesting as opposed to endless ticking of samples. And this is something that in the pipeline, and I'm currently working with quite a lot of firms trying to set up task force and working group to make it happen. Over the last 3 months, because I joined 3 months or 4 months ago, what we have been focusing on the topics that we found people either need more or have a bit of maybe questions. And the way we identify these topics is by doing our quality reviews. I don't know whether you know, but there is a person called Rayland. He is from Global Office, and what Rayland does, he goes around member firms and he reviews files, then he feeds back to audit committee and to myself on the areas where teams need help. And we have focused on 4 main areas. The first area is sampling, and I think I can see a few familiar faces and names. So the people who attended sampling sessions I ran last week and week before. If you missed it, no worries. There is a recording. There are 3 recordings in the members area, and I can just show you here. So just go to members area under service lines, audit and assurance, and here you can see Nexia audit methodology sessions recordings, and here's the recordings of the sessions on the sampling tool. So what the session was dedicated to, as name says, I was talking about sampling methodology and sampling tool that we have developed, and it is available for free to all member firms, and it is again accessible on the members area, so you can use it. So this was the first areas that we have focused. The remaining 3 areas are the ones that I'm going to talk about today. It's controls, it is materiality, and group audits. And the reason we focused on controls, and this is the first topic of our webinar today, is controls have an unfortunate reputation for being difficult to test because it is quite often complicated, and it requires quite a lot of experience to assess whether control has been designed and implemented and whether it operates effectively. And we are just in the beginning of our journey when it comes to controls. I'm not going to cover everything on controls from A to Z. What I'm going to talk today is what we have developed to help you to test controls, and just also to cover some basics when it comes to controls testing. After controls, we will move to group audits, and the reason we choose group audits is because there is a updated auditing standard on group audits, and I'm not sure about the mix of teams here, whether you're a component auditor or a group auditor, but I will try to look at to explain some pertinent points from both perspectives, either component auditor or group auditor. And the last topic is materiality, and here we just wanted to harmonize our approach to how we all set materiality across the network. And the way we did it is by writing a manual, materiality manual that will cover everything materiality, plus setting percentage ranges for materiality and performance materiality, and also developing a template. So this is the menu of what is on offer today in this remaining 40 minutes or 50. Let's dive in. I'm going to share my screen. Hopefully you can find my presentation. Here it is. Let me just minimize it. All right. Hope everyone can see it. Can just someone give me a thumbs up, anything, emoji, because I can't see thumbs up. Any emoji in the chat to let me know that you can see it. Anything. Any sign. Or you can just say yes, you can see it. If you're struggling with which emoji to put in the chat. All right. Thank you so much. Great. All right. Let's start with controls. As I said, controls have an unfortunate reputation of being difficult, and quite often, excuse me, I need to add people to the thing. All right, and quite often what we think when we test controls is, well, when we think about controls overall, we think, why do we need to test them? Was there any point of testing them? And the thing with controls is it is important. It is important to think whether we need to test them and whether we don't need to test them, but also taking into account what kind of audited entity we are dealing with. Because if we are auditing a very small entity, quite often controls will be informal and they might not meet requirements of the standard. And in that case, perhaps the most appropriate approach would be to rely on substantive testing alone where possible. Where entity is more complicated, more complex, and for example, it's a listed entity or it's just quite a sizable entity, is privately held, and there are quite a lot of complex areas, and your overall from what you discussed with a client, you see that control environment is actually pretty good. It may benefit for you to test controls because it will have a positive impact on the amount of audit testing you will need to do subsequently. So let's start with the basics. So what are controls? And standard defines controls as a policies or procedures that entity establishes to achieve the control objectives of management or those charged with governance. And it includes policies and procedures. It's quite a dry definition. However, what I want you to focus on is control objective. When we are looking at controls, the first thing when I look at the control is the description of control. I'm trying to understand what exactly the control is trying to achieve. And by control objective, generally what we mean is the risk of material misstatement the control is designed to address. For example, if we're talking about bank reconciliation, which is one of the examples of controls, the control is designed to ensure that bank account is not materially misstatement. And this is your sort of a litmus test. So if you look at the controls, if you look at the description of controls, and if you are talking to a person who is executing these controls, and they cannot clearly articulate why they're doing the control, or they cannot clearly articulate what this control is trying to achieve. So this might be the first red flag for you that maybe control environment is not good enough, and maybe there is no point of testing controls at all. So the first thing, like with everything else when it comes to audit, try to understand what the information is telling you. The first thing is what control objectives the control is trying to achieve. And if it's not clear from the description of the control, try talking to control operator. Control operator is the person who is performing the control. Generally, we are encountering two types of control. It's preventive controls. They are designed to avoid to prevent errors happening, for example, inspection approval. So it's something that designed to prevent misstatement to occur. And detective controls are the controls that trying to identify the errors that already happened, and then try to correct these errors. The reason it's important is because later on I will be talking about the control samples size table, and generally detective controls, they operate more frequently, so you would need to test more instances of control, and preventative controls, they tend to operate less frequently. So this is the basics. So hopefully everyone is on the same page. So controls are something that is designed by management to address the risks of material misstatements. Now let's talk about what do we need to do when it comes to controls. As I said, depending on the type of the entity, depending on the nature, on the control environment, you might be right in concluding, you know what, I'm not going to bother with controls, I'm just going to do substantive testing. And it is a perfectly sensible decision as long as you know that it's what you need to do. However, there are minimum requirements that you need to do. Even if you're not relying on controls, you still have to test design and implementation of controls. And we have to do it regardless, as I said, whether we're going to rely on controls or not. So when do we need to test design and implementation controls according to the standard? So first of all, we need to test design and implementation of controls when we are planning to test operating effectiveness. Well, this is quite clear. The second instance where we have to test design implementation of controls is where we identified significant risk. And this is something that we have seen across the network when we do quality controls, is that we have identified significant risk and we decided we are not going to test controls, but we didn't test design and implementation of controls. So if I wanted to take away a single thing from this webinar, is if you have identified significant risk, you have to test design and implementation of controls, even if you're not planning to rely on operating effectiveness of the control addressing significant risk. So what do I mean by design implementation of controls is that you need to inquire what controls is comprised of, control objective, who is operating control, what is the precision, etc. And then you need to test one instance of this control operating. So this is the bare minimum you need to do. And the second point in the second bullet is controls over journal entries. And this is something, I think journal entries overall is quite difficult topic due to sheer amount of journals. And even again, if we are not testing, even if we're not planning to rely on operating effectiveness of controls, we have to test design and implementation of journal entries. So remember, if you have significant risk, and we always have journal entries, so we always have to test design and implementation of controls, even if we are not planning to test operating effectiveness. This is what standard requires. And another requirement is, so this might be other controls that we planning to test. So for them, we would need to test design and implementation as well. One thing that we frequently forget, and it especially, I think, prevalent now, for example, if maybe not in the small entities, but maybe at the entities that are growing, there is more and more and more technology involved in everything that we do. And quite often controls are either relying on IT, for example, control that matches your, let's say, your invoice to your purchase order to your payment. This is a control, and it uses IT it uses IT system to match all three documents together. So this is one example of using IT. Example of where control relies on IT is, for example, control operator is investigating an exception report. So exception report is produced by the IT system, and in our case, where I was explaining matching of invoices to payments to purchase order. So this is their IT element, and this is a control. This is the first part of control where we match all three documents, and the output is exception report, where the person, control operator, goes through the exception report trying to identify why, for example, invoice doesn't match to payment. And this is example of where we use IT, and we do also rely on the reports produced by the IT. And this is very difficult area. The reason being is because I think quite often we rush in our understanding of what control actually uses, what kind of data control is uses. So it's very important to step back and identify as a minimum what data control is using and whether IT is used in the control. And where IT is used in the controls, then we need to test IT element of it. And this is a completely different topic, and it's something that I think every one of us is acutely aware we need to do more. And this is something that myself and the task force I'm working with are planning to look at next year to help you guys to kind of have a simple document to help you to identify whether you need to test IT controls, and if you need to test them, what you need to do. Just to wrap up on this slide, the main takeaway is even if you're not planning to test operating effectiveness of controls, you have to test design and implementation of controls, those controls that address significant risk, those controls that that address journal entries, and also controls that relate to IT. This is the bare minimum you need to do. Now, how can we help you with testing controls? The reason we have also focused on controls, apart from the fact that it's quite a difficult topic, is that when we designed our sampling tool, there is an option to select, do you rely on controls or you don't rely on controls? And what it does to your sample size is it reduces sample size significantly if you have tested controls and controls are operating effectively. That's why we have created a little document, and this is kind of an extract of the chapter that I'm currently writing to give you guidance on when you need to test operating effectiveness of control, to give you sample size table when you test the controls, to give you guidance on what you need to do when you identified a deviation in control. And as with everything else, it's saved. It's published here under sampling. And the reason it's published under sampling is because it's a bit of a nerd information, but it's ISA 530 sampling that deals with controls testing. So that's why it's there. And I lost my train of thought. Okay, here it is. So it's called Nexia Methodology Manual Chapter on ISA 530. And it's an extract, so it's not full, a end-to-end chapter, but what it does, it provides a simple question and answer format of what you need to do, what you need to think about when you are testing controls. As I said, it explains when do we need to test operating effectiveness of controls. So remember, with design and implementation, you have to do it if you have significant risk, if you're testing journal entries, which we always do, and if we are planning to test operating effectiveness of controls. So when do we need to test operating effectiveness of controls is simply when we decided to test operating effectiveness of controls because it will help us with our audit procedures further down, or for example, when substantive procedures alone just unable to provide audit evidence. An example I think the most common example I have seen is, for example, when we test estimates. I don't know how common you come across estimates, but with complex estimates, because it requires so much judgment, you just try to get as much audit evidence as you can, and controls is one important part of it. The chapter then gives two tables, which shows how many instances of control we need to test depending on frequency of control of operating of control. It's probably familiar to every one of you. So if a control is annual, then we test one instance. If it's quarterly, monthly, weekly, we test this number of controls. And the same goes for the controls that operating more frequently. We test corresponding number of controls. One thing that actually I would like to bring out here, and I strongly advise you to read the document, it's only 5 pages, is through our discussions, we came up with a proposal that, for example, if I'm testing two controls that are addressing the same assertion, for example, I have a detective control and I have a preventative control, then I will be able to take a credit for the first control by reducing a number of sample sizes. So for example, I have a preventative control, which I tested, it's a weekly control. I have tested 5 and it's operated effectively. Obviously depends on the level of inherent risk. And then I have the same, I have a transactional level control, a control that operates more frequently. Because I have already tested one control that there is the same assertion, I can reduce sample sizes when I'm testing my second control. So here, but for example, we test 2 or more controls addressing the same assertion. So instead of 45, I would be using 25. So it's incentivizes you to identify relevant controls to help you with your audit testing. The one thing that I also want to touch is actually a couple of more things. The first one is controls that have automated component to it. Just to come back to what I was saying earlier, that we do really need to understand what control this comprises of. If control has automated and manual components, we need to test them separately. And the guidance provide example of this kind of control. And another point which is very important is deviation, i.e. when, or control deficiency, another word for it. So for example, you are testing controls and you are, I don't know, you selected 25 and you are on your 24th sample, and then bam, you identify deficiency. For example, something is not operating how it should be. And the advice here is to investigate it, understand why it happened, and quite often you probably will be better off by stopping your control testing. The guidance does give advice on what to do if you identified one control deviation, but it's quite strict. So if you, for example, identified the control deviation and you decided to proceed, you need to test more, essentially 15. And if you find second deviations, that's it. So you can't rely on controls. So for the efficiency's sake, do try to understand what happened, why the particular deficiency occurred, and if there is a high chance of it occurring again. And let's face it, it's quite often it's a human element, and there is always a chance of it occurring. Probably you will be better off with stopping testing the controls. And remember, once we have concluded that controls are not effective, we have to revise our inherent, level of our risk of material misstatement. Remember, risk of material misstatement comprises of inherent risk and control risk. So once control risk is high, then our inherent risk will likely go up as well. So do remember to come back to reassess your initial risk assessment. So this is what I wanted to cover on controls. Just quickly, and I actually realized that I'm a bit running late. So I will just quickly go through this slide, and I appreciate it's not the most useful slide, because ideally I think what I would like to give you is encompassing guidance on how to evaluate your data. See, I am passionate about data analytics. How evaluate your design and implementation of controls. Because what I find with such things, for example, determine control objective. Do we understand what control objective is? It's one thing to say, do we understand what the control objective is? But I think everyone will be asking how. How do I understand it? How do I conclude that control objective is indeed addressing risk of material misstatement? Or, for example, assess the level of precision. How would I know that the control is precise enough to detect material misstatement? So this is questions that I want to answer and give to you, and this is something that is being developed. So for now, I will share the slides, and it's just something for you to remember when you are doing design and implementation of controls. But I am acutely aware that it doesn't answer the question how, or it doesn't answer question of so what. So just bear with me. All right, so this is everything that I wanted to say on controls. Just to wrap up, the guidance is saved here under sampling in audit publication and guidance. And if you're perfectly in your rights not to rely on controls. But remember, if you do rely on controls, you might, and if they are effective, you will get reduction in the sample sizes if you are doing test of details. Regardless of whether you are planning to test operating effectiveness of controls, you have to test design and implementation of controls when you have a significant risk and when you're testing journals. And because if there are any IT elements in either of these areas, you will have to also address IT element. So this is what I want to leave you with on controls. I'll just admit some people in. The second topic is everyone's favorite, well, at least it's my favorite, group audits. It caused quite a stir with group audits, and I think I wouldn't say it's something groundbreaking. I think what I remember when I was doing group audits, I was always quite puzzled by the fact that as a group auditor, I will issue some instructions to my component auditors. They will do some work. So I basically, you know, throw the problem over the fence. They will work on this, and then they will throw the problem back to me, and I will attach it to my audit file, and I will sign the audit opinion. So I always find it a bit bizarre because you're signing the whole group audit opinion, and you're basically relying in your audit opinion on something that someone was doing. And I'm not saying that what they were doing was not wrong, but you didn't have a proper oversight. You don't know whether all significant risks have been identified, whether all risks have been assessed, and things like that. So this is what the standard essentially is doing. So you all probably know that a couple of years ago, or 3 or 4 years ago, there was a revised standard on risk assessment, ISO 315, and group audits have been revised to align to ISO 315. So essentially, the way I look at it is you look at your group audits as if you're doing your normal standalone audit. So when we are doing standalone audit, if it's a big engagement, or even if it's small engagement, you sit with your team and you all collaborate, you discuss issues, you discuss audit procedures, risks, and things like that. And group audits now are exactly the same. Granted, no, there are lots of components, and they're sometimes based in different cities in different countries, but essentially, virtually, you just the same team that is working together. And this is what the group audit new revised standard is doing. The main changes, as you probably would have guessed, relating to how risk assessment is conducted, how components are scoped in for the work, and the enhanced communication between component auditor and group auditor. So I'm going to go through each of them. So I already touched upon it. So essentially what we are doing now is, as a group auditor, what I am expected to do, if before I would just look at my significant risk, identify some areas and say, okay, fine, this is areas that I'm really worried about. The rest, I will just rely on on component auditors to do. Now, upfront, we will have to, sit down with, take our draft financial statements or our trial balance and get everything that we know about the entity, all our understanding of the environment, regulatory requirements, external environment, financing, all of these things, so all this wealth of information, all our communications, inquiries with management, and we need to identify all group risks of material misstatement. So it's a lot of work. It's a lot of upfront work, and it is the same as we are doing on our standalone audit. On standalone audit, we do go through each account to try to understand if there is risk of material misstatement, and if there is risk of material misstatement, whether it's significant, elevated, or normal. For the component auditors, because now I was speaking from the group auditor perspective, what does it mean for component auditors? So for component auditors, it doesn't mean that they just sit back and relax. Because the standard is relatively new, I mean, it's the first year when everyone is using it. If you are a component auditor and you know that last year you were scoped in for group audit and you haven't heard anything from your group auditors, I would encourage you to, just to reach out to them and see what they are up to. Do not expect that whatever you were doing last year is going to be exactly the same as this year. It's likely will be to be more work. And another thing for component auditors, maybe some of you already come across it, is even before group instructions are issued, the group auditor can reach out to you and ask you to help with risk assessment, because it's depending on the structure of the group. But sometimes, if, for example, if the group is really spread out across different regions, it's very difficult for group auditor just sitting in a group in a HQ and headquarters to identify, to know everything about each component, to be able to identify group risks of material misstatement. So group auditor might reach out to you to ask you to help in group risk assessment procedures. So be aware of it. And as I said, if you haven't heard anything, reach out, because it will also help. First of all, group auditor will be thankful that you know projects, but also it will help you to be prepared for what is in store. And what is in store is more work, unfortunately. Or, well, if risk assessment wasn't done properly before, maybe it will be less work if a group auditor is able to maybe to pinpoint the particular areas that they are worried about, or they are able to do the work themselves. So the first point to take away from group audits, from both component and from group auditor perspective, is that now group audits, as in terms of the approach, is exactly the same as a standalone audit. You are required to spend lots of time doing proper risk assessment so you can identify where your risk areas are. For a component auditor, expect early communication and expect to help group auditors with risk assessment procedures. The second point is scoping. You might remember, group auditors, those of you who are group auditors, that before the standard says, okay, you just need to scope in, I think it was individually significant components, if I remember correctly, and I think the standard even gave the percentage. I think it was 15% of total revenues. And then the standard says you can also scope in components based on significant risk. So now things changed, and they changed exactly because of the risk-based approach. The way group auditors is now scoping the components is purely driven by the risk. The size still matters, but it's most the level of risks of material misstatements that influence the scoping. And I just want to bring out this little flow chart. Let me just, sorry, everyone. This little flow chart, just to give it a bit of, to give you an overview of what the process looks like. So when it comes to the scoping, so we start with gathering all the information we know from the risk assessment. And as I said, the group auditor might do risk assessment on their own, or they might also involve component auditor to help them to understand business processes, business environment, any changes in the external factors to pinpoint this risk of material misstatements. So this is the first step. The second step is we determine all components that are making up the group financial information. And this is a step that we always done. So we just basically need to get the consolidation schedule and just identify everything that it totals up, every single component that totals up the consolidated financial statements. It doesn't mean that we're auditing every single component, but we just need to make sure, as with any other audit procedures, that the population that we have is complete. The third step, and this is what I personally, I think, like that the standard brought more clearly, is even before we dive into scoping, okay, component one, component two, we actually, as a group auditor, we step back and think, is there anything we can do centrally? Because let's face it, it's just more efficient to, if you can audit things basically without leaving your office, it's just make more sense, and it's more efficient to do. So this is a question that we need to ask ourselves. Okay, can we audit some accounts centrally? And there are considerations in the standard and also in the guidance that we have put out. I will come to it later, that help you to understand what you need to think about when deciding whether you can test something centrally. So common example, let's take revenue. And so the group sells exactly the same stuff across the whole world, and it's revenue recognized, point of time, all the standard contracts. There is one financial system that deals with it. There is one distribution system. So everything is exactly the same and controls are the same. And most importantly, you sitting in the headquarters, in the parent entity headquarters, you can actually access all information on your own. So you don't need to ask component auditors to give you anything. So this is an example where you can just say, look, I can actually do it on your own. And this is something, so if you identify this kind of accounts or areas, so you don't need to ask component auditor to help you to audit it. You can just do it on your own. So this is your step 3. Step 4 is where we identify individually relevant components. So notice slides change individually relevant components. So before, I think under all standard we were talking about size. Now individually relevant components. So how do we determine these individually relevant components? A, we look at the risk of material misstatement. So for example, if a component has lots of risk of material misstatements or has a significant risk of material misstatements or have other pervasive risk of material misstatements, most likely we're going to scope them in. Another, so this is first criteria. First 2 criteria, the significant risk or just huge magnitude of risk of material misstatements. Another criteria is size. Yes, standard doesn't stipulate the size, but it doesn't mean that we can't use the size. We, in the guidance, we didn't give you any percentages, but it's up to your judgment. So if you have a significant component and let's say there is nothing funny going on, so maybe all risk of material misstatements are base, but because it's just big, you're probably most likely to scope it in. So we look at all our components. We identified individually relevant components. So we looked at them so they were like that. Now we're going to look at them horizontally. So we looked at them vertically. Now we look at them horizontally. What does it mean? So after we have scoped in all our individually relevant components, we need to go through each account where we identified risk of material misstatements to ask ourselves, all right, do I have enough? And this is what called step 5, evaluate residual significant account balances. So for example, if we take revenue, we have scoped in 3 components, the remaining, let's say 15, we decided not to, but we need to look at the remaining balance that is not covered by scoping procedures. If it's big, probably there is a risk of the material misstatement occurring there is probably higher as well. So you would need to decide whether you want to scope in. Like with your normal standalone audit, sometimes we call it like remaining population. So we tested, I don't know, some trade receivables. And then we look at our remaining population and we're like, I'm not comfortable. I probably will scope in more accounts. The same goes with group audits. You just look at each group account individually and ask yourself, okay, do I need to scope in more? And the guidance provides steps on what to consider when you scope in the components, additional accounts to reduce the risk of material misstatement. So it is most likely to result in more work overall for group auditors. For component auditors, I think the main change will come in from what you're asked to do. You might be asked to perform the whole audit of a component, and examples when we can ask a component to do the whole audit is when you have lots of risk of material misstatements. It just doesn't make sense to split them. You just ask them to audit the whole financial information of the component, or the component might be asked to do specified audit procedures, i.e. specified audit procedures. I think sometimes we confuse it. It's not an audit, it's just instructions. Okay, you have to do X, Y, Z and report back to me. So there is no judgment involved. You just tell component what to do and component will do it, and then they will report back to you with findings. The standard also introduced another type of work, which is called where you focus only on assertion of specific accounts. So for example, with revenue, remember I said maybe we can test it centrally, but maybe there is some assertion of the revenue where we can't test centrally, so we can ask components only to focus on this particular assertions. So just to bring it all back to the beginning, most important point for you to take from it is that when we do our scoping, it's all risk based. You start off with identify how many components you have. Then you think by looking at the criteria which are in the guidance, can I test as a group auditor, can I test something centrally to reduce back and forth with the component? Then you look at individually relevant components, you identify them, and you identify them either through size, or you identify them based on how many risks or material misstatements they have, or whether they have a significant risk. After you have scoped them in sort of vertically, you look at them horizontally. You look at each group significant account and ask yourself, do I have enough, let's kind of in old money, do I have enough coverage? How much coverage we didn't specifically, we didn't put it in the guidance. We leave it to the audit, to your judgment. So it's up to you. And I mean, my personal view is maybe 70, 80, but it's not based on anything, so don't take me up for it. But so it's your judgment. You need to look at the remaining population at each account to see whether you need to scope in more. And then if you need to, you can scope in. And after you have done all of it, step 6 and step 7, which again is covered in the guidance, helps you to determine your component performance materiality, because standard no longer talks about component materiality. And it also helps you to assign the scope to relevant components. And another last piece is just briefly the enhanced communication between group auditors and component auditors. It is really important, especially for group auditors. So as I was saying in the beginning, remember, in the old days, you send some instructions and then you don't see your component auditors for 3 or 4 months. And then after 3 or 4 months, they give you something and you're like, okay, right, thank you so much. You just attach it to your audit file and then you're all done. So now you're basically working with them as one team. What it means? It means if they're doing risk assessment, checking in with them, looking at the risk assessment to see whether there is anything else they have identified, checking in with them through all their audit, asking, okay, guys, so what procedures you are designing? And actually, the important point, if they are designing procedures to address significant risk, you have to review the design of these procedures to make sure that you are happy. You basically you are responsible for every single step they are doing. So you need to demonstrate to a regulator, to the reviewers, that you were fully involved in how they executed their audit. It doesn't mean, it doesn't have to be onerous, so it can be something sensible. I don't know, regular check-ins, maybe some quick review of some discussions with minutes documenting the discussion to demonstrate that you were aware of what they're doing. And one of the things that group auditors also need to do is to review the work papers. It might be virtual, or you might go and look at their papers in the office. So the enhanced communication is the key. And just remember, you basically need to approach your group audit team, which is now comprises of group auditors and component auditors, as one single team. So what it means for component auditor? For component auditor, it means that there will be more communications, more calls, more meetings coming from group auditors, and they will be closely involved in what you are doing. And to help you with this extremely complicated topics, we have developed the templates. So the first template, and it's quite low-tech template, and I'm planning to move it to the cloud to help. I should have downloaded, apologies. Now I can open it from here. Actually, let me download it. Okay, so what this template is doing, it focuses on the scoping, on the risk assessment and scoping. It's very elaborate template, and it takes you through so it gives you a summary of main changes, and it also takes you through the main steps that you need to do in doing your audits. It gives you instructions step by step. It gives you how to calculate your group performance materiality, and my personal favorite, it gives you group audit FAQs, which cover in more detail how to do your risk assessment, how to identify individually relevant component, and also it explains how to calculate your component component performance materiality. So this is the first template. The second template is for group. I guess both of those templates are for group auditors, because from component auditor perspective, you're just kind of doing your work in normally, and this review template helps to meet the requirement to demonstrate how you were involved in your component auditor's work. It's very long, admittedly, but it covers everything from A to Z. So please use it. And also we have put group audit instructions. We release them quite late, so they're sort of optional, and we're going to update them maybe in end of Q1 or Q2. So watch this space, and if you have any questions on instructions or any observations, please drop me a message or drop a message to ask@nexia.com. I have seen a few communications already, and I'm kind of trying to update templates if there are some typos or things like that. So just rounding off with group audits. So what I want you to take away from group audits: as a group auditor, you are expected to do detailed risk assessment as your normal standalone audit, and you are expected to communicate with your component auditors more frequently, and you are expected to do more work. For component auditors, the message is probably the same. You are expected to do more work, or maybe less, depending on how you are scoped in by the group auditor, and you are also expected to have closer communications with group auditors. And this is what I wanted to say on group audits. And now we are moving to materiality. Materiality is one of those topics. Well, first of all, I want to say it's my favorite standard because it's really short. But it's something that I think people either find just way too easy, or it's some of those things where it's just a bit, oh, you know, it's judgment, and I'm just going to use my judgment by whatever, and that's it. And what I believe in is that the standard actually provides you steps to help you to exercise your judgment. And what we have done in Nexia, we have wrote the manual, which is here. It's quite a long manual, and I'm planning to move it to the cloud as well, so you can access it, and it's more kind of interactive. But it basically what it does, it covers everything it covers the whole standard from A to Z. So it explains materiality concept, because actually materiality is not even defined in auditing standard. It's only defined in the accounting standard, where it says that material is something that where omission will impact the decisions of the users of financial statements. So it covers all the concepts under materiality, and it also gives a little table on percentages. And so this is the first thing that we have created. And the second template is, did I cross the same thing? Sorry. Oh dear. Okay, just bear with me. It's a template for people to use. And what it does, it takes you step by step through the through the main bits of materiality to help you to exercise your professional judgment. It splits into distinct chunks, and it's quite short, but hopefully covers everything. Let me just quickly show you, and then I will go to the presentation. Yeah, so it splits into main sections. Planning materiality, we start with identifying which industry we're operating on, adding all our figures, asking ourselves, do we need to average materiality or not, and then thinking about what else might influence our materiality, and then adding numbers. Here, it helps to set performance materiality, again, with some factors. Here we are setting low materiality for specific balances, and of course, at the end, or as audit progresses, we need to reevaluate and, if necessary, revise materiality. So now about the steps. I have dealt quite a lot of these materiality queries through my career, and maybe because I've dealt with quite a lot, I don't think materiality is that complicated, as long as you are following in all your approaches when it comes to materiality, you follow in the appropriate steps. And the thing why materiality is important, if it's too high, then you risk the fact that you might sign wrong opinion, your threshold is too high to detect material misstatement. And hence the users of financial statements who will be using the financial statements that you signed on might make incorrect decisions. And B, if you set materiality too low, then you're risking over auditing. That's why it's important to follow the steps. And the first step, like with any audit, is to understand what we are auditing, what the entity is doing, who are the main users of financial statements, what they are most interested in. Quite often, just a plain vanilla, it probably will be, let's say we're talking about privately owned entity. So there will be owners, so they will be interested. There will be bank. There will be, I don't know, tax authorities, and maybe there will be employees and maybe general public. So you need to identify all of these groups and then just think what would be most important for them. And to help you to identify what will be most important for them is you pick up the metrics that are most likely to be important. So generally it's revenue, profit, total assets. For example, for bank, it probably will be net assets. For owners, it will be profit. For, I don't know, someone else, it will be revenue. So this is your step 2. The third step, and this is something that I frequently see we are doing. So we are so focused on identifying benchmark, on setting this one number, that we completely disregard every other metrics. But remember, we start with identifying the list of metrics. So generally it's total revenue, profit, and let's say total assets. And what we need to do in the third step is to kind of rank these metrics. Okay, what is the most important, from most important to least important? So if it's profit generating entities, probably the first most important will be profit. The second most important probably will be revenue. The third most important will be net assets. And why it's important, why it's important to range it, I will come to it later. The fourth step is select the most appropriate metric. Here, I think, again, some challenges in what is the most appropriate metrics is. What I've seen is sometimes you look at the profit, it's a profit-making entity, but because margins are so low, while profit is important, it's just too small to reflect the size of the business, because not only you need to think about what the users of financial statements are interested in, you also need to think how I'm going to do the audit and whether a particular metric reflects the size of my business. Because if profit is too small, while important, but you have a massive revenue, you have massive balance sheet, you need to balance it out. So you need to select metrics that would reflect the size of the business. And in selecting this metric and then setting materiality, you would also take into account the importance of profit. So I think generally I go just, okay, fine. I look at the metric. If it's kind of okayish in terms of if it's profit, if it's not too small, I will go with profit. Or if it's, I don't know, assets heavy industry, maybe I will go with assets. After that, you determine the amounts of benchmark and other relevant metrics. And here again, important steps that we need to do is it's mostly relevant to profit. Quite often, when we get to the profit, there might be some delights, as, I don't know, owner might have taken out some dividends, which again, reduced our profit, or there might be something, disposal of the business. So something that doesn't occur, that doesn't represent normal continuing operations of the business. So this is your first thing. When you look at profit and you think, yeah, but maybe it's too small, do check, is there something in the profit that doesn't represent normal continuing operations of the business? If there is, then you can adjust for it, and then your profit will increase. The chapter explains how to go about it, so more information will be there. Another thing to think about is whether, for example, you want to go with profit, but your profit kind of up and down. You might consider whether you can average it. If it's something that just one off, and you know that profit will recover, then it will be appropriate to average. So let's assume we have identified our benchmark we have identified our amounts, and now it comes to setting the amount and selecting the percentage. Generally, I know that most of the people just select a number, which is fine. So for example, X number, but then you need to sense check whether this X number is appropriate based on what you have. And the way to to assess it is to calculate the percentage of your amount, of your materiality amount against the benchmark. And then think, all right, so if I have, for example, for profit, according to Nexia guidance, I can set percentage between 3 and 10%. And I am, let's say, 9% of profit. And I'm looking at my business is stable. I'm looking at my debt covenants, they have high headroom. I'm looking at other factors, and it all supports this high percentage, then it's fine. If on the other hand, you know, the business is not doing that well, and there are quite tight headroom on debt covenants, then it would be more prudent to move your percentage down and to reduce your materiality. With listed entities, the advice is to start at the lower percentage. So for example, for profit, as I said, it's 3 to 10%. Let me actually show it here. So if I'm listed entity, I probably will start at 3%, and then I will see how I go. And I'm just conscious that actually 2 minutes left. So one last thing that I want to say about materiality is, remember I was saying that we are so focused on the one benchmark, but it is very important to balance your benchmark against other metrics to make sure that you are not missing anything. The materiality is a judgmental amount, and the best way to set it is to assess where your materiality sits against other metrics. It's like almost a gravitational pull. So imagine this is a materiality, and remember, so this is profit, based on profit, and we know that our second most important metric is revenue, and our third most important metric is net assets. So we need to make sure that when we calculate our materiality as a percentage of revenue or percentage of net assets, we are not miles apart from the ranges. What it means is that we take into account the importance of revenue. To give example, if, for example, we are setting, it's an asset-heavy entity, and we decided to set our materiality based on total assets. If we ignore profit measure completely, so for example, we set materiality at 3% of total assets, and when we calculated our materiality based on revenue and based on profit, we are, let's say, I don't know, 20% of profit and, I don't know, 10% of revenue. What it tells us is that we're completely ignoring P&L, which is not correct. Even with assets heavy entity, the owners are still interested in P&L. So we need to reduce our materiality to bring our materiality closer to the ranges. So this is the most important point I want you to take out of the whole materiality topic, and it is covered in the guidance. Do check your materiality against other metric. Do not just set your materiality based on one metric and then ignore all the rest. It's not what standard is asking to do, and you are risking to plan your audit inappropriately if you just focus on one metric. Right. Sorry, I ran out of time and there is no questions. No time for the questions. So what I'm going to do is I will pause the video and I will also send out this presentation so you can have a look. But as I said, everything is actually in here. I already lost. So all of it is covered in the materiality chapter, and please use a template. So thank you so much for your time. And I think we have a question from Mafrin. When using the Nexia sampling template, the number of samples selected often reaches around 30 due to materiality level. Are there any approaches or adjustments we can consider to reduce the sample size without compromising audit quality? So to answer this question is, so the Nexia sampling template takes into account what kind of work you are doing. So if you're not doing anything else apart from substantive testing, i.e. you're not testing controls, you have assessed your inherent risk appropriately, so it's normal, elevated, or significant. You are not taking any credit from any other substantive procedures. There is not much can be done. So it's all based on the statistical method, and it reflects the risk you have assessed for this particular account. The only way for you to reduce sample size is either to test controls or take credit for substantive procedures. And again, there are quite a lot of criteria, or have a hard look at your inherent risk. And I'm not saying to revise your risk down, but from the discussions I had with some teams is we sometimes when we assess risk, we don't really actually precise enough in which part of the account is subjected to risk. For example, with revenue, sometimes we just say, oh, it's all significant risk. Is it? Can we pinpoint where our significant risk and then test a particular bit with significant risk with high sample sizes and test the rest of it with the lower sample sizes? So there are a few things you can do. It's either taking a hard look at your risk assessment without compromising audit quality, B, testing controls, C, taking credit for other substantive procedures, or another option, if, for example, you don't have significant risk, you can do substantive analytical procedure, which might be difficult, and it depends on type of revenue, but it might help you to not to do sampling at all. So I hope it helped a bit. So thank you so much. This is what I wanted to say. I hope it was helpful, and please drop me a message I will be happy for any feedback, or if you want to hear about something else, let me know as well. I will be sending out email with recording maybe today or tomorrow, and with the slides as well. And as I said, we are working hard to develop more materials and to hopefully develop data analytics tool to help you, Muffin, not to do samples at all, to use data analytics on your audit, so it will be all easy breezy. All right. Again, thank you so much for dialing in, and hope to see you next year. And if I don't talk to you, Happy New Year. Thank you. Joanna, do you have a question? Oh, thank you. Thank you, everyone.